Hello, everybody. Welcome. Welcome. Just waiting for a few more people to join us. But while we do, I'll kick things off because we've got Anthony's going to be covering loads and loads of things for you around the legal sides of your fundraising. So let's kick off. I just want to just a bit of housekeeping before we start. If you want to use the chat to ask any questions, I'll keep an eye on that chat, and I'll ask them with Anthony throughout the event. We might have time for a Q&A at the end, but if I could just ask you to keep all of your microphones off just to avoid any background noise or reverb, that would be super useful. And hopefully our internet connection stays stable and you'll be connected to us the whole time. So here's hoping. So just before we kick off, a quick introduction to Robot Mascot. So we create investment materials that convince investors, for those of you who don't already know us. We essentially create pitch decks, projections, business plans that'll help you and give you all the assets you need to convince an investor your business is the one to back. Our clients are 30 times more likely to raise the investment that they need, and we're recognised as the UK's leading pitch agency, and we're trusted by the likes of SeedLegals, obviously, Crowdcube, Seeders, Dent Global, and a number of other accelerators and incubators. Essentially, we just believe that great things happen when powerful innovation meets inspiring communication. It basically has the power to change the world, inspire movements, build brilliant brands, and also raise funding. So that's at the heart of what we do here at Robot Mascot, is helping you communicate your great idea to investors. And we get frustrated when we see ideas failing simply because of poor communication and nothing else. So a couple of things from me. Just thank you to anyone who bought a ticket for good for today's session. So you've helped us support women in Kenya from less privileged backgrounds to build their own business and take their family and their communities out of poverty. The project we support with the money that you've donated today through the Ticket for Good has helped over 550 women help a business skills course. And there's more than 100,000 worth of dollars worth of small loans that have been issued to these women in Kenya. So thank you if you purchased a Ticket for Good today. We really do appreciate the support. Last couple of bits from me. If you haven't already, you might want to take our Pitch Ready Scorecard. It's a completely free assessment. It will take you less than 5 minutes, and you'll get a 12-page report on how to improve your investment materials and position yourself to be an investable entrepreneur, the kind of entrepreneur that an investor wants to back. And if you do need to drop out of this at any point, or you know some people that might be interested in the things that Anthony's going to talk about with you today, the recording of this session is going to be posted into our Facebook group called The Investable Entrepreneur. So if you want to join that group, you can get access to the recording of today's session later on today. And that's it. Without further ado, that's the introductions over. So I'd just like to introduce Anthony, who's going to take you through the 10 most important things that you need to consider for your fundraising round when it comes to your legals. Anthony, welcome, and thank you very much for being here.
All right. Hey, James. Thanks. So, hey, everyone. I think some might know me. I see some familiar faces. So I'm Anthony. I'm founder and CEO at SeedLegals. I used to head up BBC iPlayer some years ago. After I left the BBC, I built a startup, sold it, built a startup, sold it, invested in a few, got tired of paying lawyers, and met my business partner and created SeedLegals, so no one has to go to a law firm again. So we've got more than 15,000 UK companies on the platform. You may have seen we've just launched in France, and but from that, firstly, I see lots of founders, and secondly, we've got lots of data, which I love to share back with everyone so that everyone can get their business running sooner and not make mistakes that I and others have done in the past. So James said, come up with something exciting for the webinar. So I said 10 things, and I have to come up with 10 things. So here goes. And we'll do this somewhat interactively, so that please post any messages on the chat, and then maybe between sections I may pick up on some of them as we go along. And for those not familiar with Zoom, you can either see a grid array of everyone, or you can set it to just see me. And I won't screen share and show a boring PowerPoint, so that I can do maximal arm waving. So with that in mind, thing number one, get your cap table right. So I'm a member of a Slack group called MVVC, Minimum Viable Venture Capitalist. And one of the hot topics at the moment is investors not investing in companies because the founders own too little equity. So when you incorporate your company, the very first thing you want to do, you have to make some shares. And there my suggestion is make 100 shares of £1 each, split between the founders. Some people talk to their accountants who say make what's called alphabet shares, A shares and B shares and C shares, and then you give everyone different share rights. Unless you're Mark Zuckerberg, don't do that. It's just friction with your investors later, and every time, bar none, that I've seen people do that, they've had to undo them afterwards, because if the investors see that the founders are trying to give themselves shares with better rights than the investors, they want to undo that. So the simple formula is incorporate 100 shares, £1 each, split between the founders, and later on, you'll then do a share split. Now, one of the problems, of course, is how much equity are you then going to give away to investors later on? And we'll get there in a few moments. But one of the key things is, as you allocate or give people more shares, you're always going to create more shares. You're never going to give away your shares, unless as a founder, you're planning to sell your shares and make some money and cash out of the business. But so rule one is always make more shares for new people. Don't transfer your shares unless there's a good reason to do so. So if you're in the UK, incorporating your company costs £12 in Companies House. You don't need any special help for that. Just remember, by default, you'll make 100 shares or thereabouts of £1 each. Easy. And ordinary shares you'll make. So the next thing now is giving shares to team members. So, when you're an early stage startup, you have shares, but you don't have money. So instead of paying people 50K a year or whatever as a salary, maybe your first hires, you're going to give them some shares. So now you've got a question, which is, should I give you shares or should I give you share options? So share option is the right to buy a share in the future, and a share is just a share. So which is right for you? And here there's a pretty simple rule, which is generally it's easier to give people shares. You don't need to create a share option scheme. People generally value shares more than a somewhat intangible right to a share option. But if the shares have got value and you give someone shares, they're going to incur tax liability. So let's say your company had a valuation of £1 million and you decided to give your friendly CTO 5% equity and you gave them shares. That would be giving them £50,000 worth of value. And not only would they have a tax liability on £50,000, if they were an employee of the company would be deemed to have given them £50,000 in value, and the company would now find themselves liable for PAYE and national insurance on £50,000. And of course, if you're doing this with lots of employees, it can be a huge problem. So when you give equity to people, if the shares have no value, in other words, typically before your first funding round, knock yourself out, give people shares, and always make new shares. But if the company has raised investment or the shares have a value, avoid giving shares, instead give share options. And a share option says, I'm going to, number one, promise you that in the future you can buy shares in the company for 1 penny each. When you do that, you'll have a tax liability, but that's later. Secondly, I'm going to make what's called a share option pool that gives me the right to give people this ability to buy shares later. We'll get back to that. And thirdly, I'm going to need to create an option scheme that encodes this right, because otherwise, what is it? So very simply, for your first company joiners, of course, when you incorporate, you're sharing the 100 shares. But as you add people, you're going to create more shares for them and give them shares. But once the company has value, you're going to stop doing that and you're going to give them share options instead. Now, whenever you give people either shares or share options, you should always give them that per a vesting schedule. So if you hire an iOS developer, you're never going to pay him or her their entire annual salary on January the 1st, because what if they stop performing halfway during the year? What if you part ways with them? Likewise, you should never give anyone, other than an investor who's paying for their shares, you should never give anyone free shares just like that. You should always give them shares per a vesting schedule. And if you're giving them shares, it's called reverse vesting. So if your friendly CTO joins and you're going to give them 5% equity, so let's say you're going to give them 5 shares and you've made 100, you're going to set up a vesting schedule that says, your shares, we're giving them all to you now, but if you leave anytime in the first 3 years, you have to give some of them back, sell them back at a penny each typically. And so a 3-year vesting schedule is most common for employees and founders and so on. And the advantage is that if you do this and things don't work out, you can part on good company. In order to do this, you need to create an employment agreement or a founder agreement that has got vesting provisions built in. It's super simple. You can do this on SeedLegals. It's essentially completely free on SeedLegals. There's no excuse not to. And as founders, by the way, you should make sure that you and your co-founders have all signed founder agreements as well. So on SeedLegals, we find that maybe 10% of the time, founders split up. I think it's higher now that everyone's working from home. Things are more stressed. You're not meeting each other. You're having angry Slack conversations, whatever it might be. And we see about 10% of the time, things don't work out. And when people message us on our web chat to go, my founder's leaving, what do I do? And our answer is simple. Do you have a founder agreement in place? If so, great. Just look up what the vesting agreement is, and they'll give back some of their shares, and hopefully you'll part somewhat amicably. But if you haven't got a vesting agreement in place, a founder agreement, then how do you know how many shares they should give back? If they keep all of their shares, your company can be uninvestable, because investors are not going to want to invest in your company if half or a third of the shares are owned by somebody who's no longer part of the company. And worse, if they've parted on bad terms, they may be having a fight about the IP, or there might be a difficult shareholder. So having a founder agreement in place is really important. So now, let me stop for some quick Q&A and look at the questions.
Just going to jump in and say we've got about four or so questions. So Jim asks, what's the best way to approach the founder protection and super voting rights at a seed stage? And he kind of follows that up saying, can this be done without being prohibitive to potential seed investors?
Okay, so founder sort of super voting rights. So generally what happens is founders start with all of the shares. So when investors come along later, everything they're doing is to create a set of shareholder agreements and other documents to protect their interests. And why do they want protection? It's because certain things can be done by just a plain shareholder vote. The shareholders by default can vote to create more shares. So the founders, because they, after the first round, typically own 80% plus of all the shares, without any additional protections, they can just do pretty much whatever they like. They can make the more shares for themselves, they can pivot the company, they can sell out, whatever. So investors, they fear, number one fear is the company will go out of business, but the number two fear is that the founders will try and diddle them and allocate themselves more shares or give shares to friends, whatever it might be. So the investors are looking to have some rights, investor consent rights, and other things to protect themselves. If you as the founder are trying to do something that's the opposite, to give yourself more rights than you would ordinarily have, that's really the investor going, okay, this is odd. So the investors start with the assumption that the founders have got all the shares and it's one vote per share. And the investors then assume that they're going to get shares with at least, equal voting rights. If they are crowd investors with hundreds of investors or dozens of little investors, having them with voting rights is a pain later. So small investors, you might give non-voting shares, so you never need to talk to them again. But any investor investing 10K upwards is going to expect to have voting rights. But if an investor sees that the founder has done something non-standard to give themselves more votes or superpowers, that's the Mark Zuckerberg reference, that really sticks out. And the problem you have is that as an investor, there are endless number of companies coming your way. So you quickly look, and I see lots of companies, you look at companies and you see if they fit a standard pattern, founders have got ordinary shares, they're in a business, they focus on growth, the founders have got the majority of the shareholdings, they haven't done anything silly up front, great, they're investable. But as soon as they see anything weird, the founders have got strange share classes, they've got 8 different types of shares, the founders have somehow diluted themselves and have got 60% of the shares instead of 80% on the first round, you become very quickly too much friction and the investors look elsewhere. So the reason Jim is asking this question, I'm guessing, is because as a founder, you keep reading that founders are fired later on and so on, and therefore you want to have super protection. But actually none of this is a problem, at least until sort of Series B or later. So, initially you've got all the rights, you've got all the power, and if investors see you've done anything strange, weird in your favor, you just become less investable. So I'd really caution against that. It just adds friction. Unless you've got several successful exits under your belt and you can do whatever you like. But if you're the average founder, you're competing with everyone else on this call for investor money. All right, so next thing, let's go to Joe. Is there a big tax implication for the person if we're giving shares or if we give them shares outside of an option scheme? So I think I've answered that, which is if you give someone shares and the company has value, then the person is taxed or has a tax liability. It's between them and their accountant on the value of the shares that they got. If you give them share options, when you give someone an option, there's no tax liability until they exercise the option and they buy the share, and then they're going to be liable for the tax between the value of the share and the amount they paid for the option, which might be 0 or like a penny. But any sane person only exercises their options when they're planning to sell the share in future. So let's say you give someone the right to buy a share, at a penny each, and now they are going to, your share price is worth £10. The person might exercise their right, pay some tax on it, but now they're going to sell the shares at £10 each, and they're going to pay tax on the £10. But that's great because they've made, £50,000 value, and they're going to pay some tax on that. That's life. So yes, that's all about shares versus options. All right. So the next thing then is If you're
Couple of other
going to,
questions if you want to go through them.
okay,
So if you issue new shares at a later date, can you apply the same vesting schedule on the same terms as your original shares? That might just be a
great point. So whenever you give people shares or options, you can always choose whatever vesting you want for that person as appropriate. It's not linked to anyone else in the past. So typically, I think they fall into probably 3 patterns. Number one, if you're giving shares to employees or yourself initially as founders, it's normally what's called 3-year straight line vesting, which means, you know, my shares will vest over 3 years. If I leave anytime in the 3 years, I have to give some of them back. And that, if you think about it, is kind of equivalent to a salary sacrifice. So it's to say, let's say I would have earned £50,000 a year as an iOS developer. But because it's a super early stage company, they can't pay me my market rate. So they're going to pay me 30K. So the shares or the share options they're going to give me should really compensate me for the value of that 20K difference between my market rate, what I could have earned elsewhere, and what you're paying me. So you might say, okay, great, dear iOS developer, I can't pay you 50K, so I'm going to give you 30K, and I'm going to give you 20K's worth of options. And they're going to vest over 3 years. So that means I really should give you 60K's worth of options, because you'll get 20K a year effectively, month by month. And so now, if my company valuation was £1 million, that means I should give you essentially 6% of the company, which is now going to vest over 3 years, which is equivalent of 60K. You're going to get diluted if I do my next round or future rounds, but that's life. I, as the founder, will as well. On the flip side, if the valuation goes up, your shares will be worth more. Now, obviously, you can't give 6% equity to too many people before you've massively diluted yourself. So generally, your first team members, who you really are going to be paying a lot less often than market rate, you're going to compensate them with a big chunk of equity. But later on, as you're paying people pretty much market rates, you're going to give them options kind of as a fun bonus, incentive, keep things interesting. And that might be between 0.1 and maybe 1% that you would give to people. So overall, you're probably going to create an option pool that's like 10% to give to people. And you might top that up a bit later. So you can go on the SeedLegals website, and there's a section resources data, and you'll see some graphs on the typical option pool size. But 10% tends to be about typical in the UK. The US is much more focused on stock options, and they might do 15 or 20%, but a good starting point is 10%. And you can always make more later.
And
so
just before we move on, I think this is a very quick one. What's the typical number of shares you would set up your company with if you're thinking of being a scale up kind of tech startup? Is it 1,000, 100,000, 100?
Okay, sure, great question.
Oh, and then finally, Keith has asked, would Anthony recommend using a solicitor to put all these documents together? I think I can answer that for you. You'd recommend using SeedLegals to do all of this stuff for you. So that one's answered. But yeah,
that's easy. So before you go to a lawyer, just hop on SeedLegals and you'll see actually you can do all of that 24/7, and we're there to help. So that's why we created the SeedLegals. So now with the number of shares, that's a great question. So what you want is, when you do a funding round, your price per share in the round is simply the valuation that you choose divided by the number of shares. So let's say your valuation is £1 million and you've got 100 shares. So that means the price per share is £10,000. But let's say you create a 10% option pool. So now that would mean you've got like 109 shares or something. And that means your price per share is £9,009 a share or some crazy number. But that means your investor can't invest £25,000 because the number of shares they get, it has to be a whole number of shares. So they can either invest £18,000 or 27,000. That's a bit meh. So what you really want when you go into your first round, you want to have something like 100,000 or 1 million shares. So your price per share is like £1 or £10. So you can very accurately match investment because you can only have an integer number of shares. So now, a few minutes ago, I said, when you incorporate, I said you should make 100 shares. Why didn't I say you should make 1,000,000 shares? And the answer is, when you create your company, if you use the normal company house interface, from what I've seen, it only lets you choose a price per share of a penny, as a minimum. So if you were to make £1,000,000 of 1 penny each, that means £10,000 in paid up capital. That means you have to write a check to the company for £10,000, but you don't really need to do that. Instead, you could just create 100 shares of £1 or a penny each, write a check to the company for £1 or £100, obviously proportional to the number each founder is going to do. I'm £33, £33, £33. And then you do a share split later to turn those 100 shares into 100,000 or 1,000,000 shares, but you've still not had to pay a great deal for those shares. Where I see a reasonably infrequent but pretty nasty mistake is where people think when they incorporate, I need to make the company valued at £1,000,000. So I'm going to make 1,000,000 shares of £1 each because it's going to value the company at £1,000,000. But no, that's too easy. Just saying that doesn't make you worth £1,000,000. But all shares in the company have to be paid up, which means that you're going to have to write a check to the company for £1,000,000. So don't do that. £100 at £1 or a penny each, and then do a share split later, which you can do on SeedLegals completely for free and takes about 3 minutes. So I'm going to get back to some questions later, and now I'm going to crack on with the next part, which is deciding your company valuation. So you've now created a PowerPoint pitch deck. Hopefully you've spoken to James at Robot Mascot to help you create a great pitch deck. And by the way, I'm just launching Pitch Deck Clinic. So I think if you Google SeedLegals Pitch Deck Clinic, or you drop me a note afterwards, what I'm doing is I see that there are many resources on the internet, how to create a great pitch deck. And there are articles that are going, here's Uber's pitch deck that they used when they raised 2 billion. Those articles, by the way, are useless. And the reason they're useless is because you could have put in those pitch decks, blah, 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 grass is greener, blah, blah. Nobody cares. The one slide in the pitch deck that got investors to invest the 2 billion or whatever was the growth curve. Everything else was irrelevant. So when you see those articles on the Business Insider or whatever, here's the pitch deck so unused, just flip through it. It doesn't matter what it said. There's just the growth curve. And if the growth curve goes north at a certain rate and the revenue growth goes north at a certain rate, investors are going to want to invest. Your challenge is, until you hit that point, how do you persuade investors to invest? And that's where you need a great pitch deck that gets investors to want to get in at the first step. So what I found is nobody as an investor invests just on PowerPoint. They want to see some validation. So my data on SeedLegals shows that founders put a median of £26,000 of their own money into the business first to build a prototype, get some validation, do some user testing, create some nice branding and so on. And only then are they ready with something that they might go for a friends and family round or an angel round. So let me take you through the 101 on investing. So to me, I think that there's a standard formula I've seen over hundreds, if not more, rounds on SeedLegals, which is every idea is different, but funding rounds follow in the UK a remarkably self-similar pattern. And I liken it to dropping a pebble into a pond. So as it drops into the pond, it's got these ripples. And if you think of the ripples as funding rounds, so the first one is the founders put in some of their own money because no one invests on an idea. The next ripple is you're going to raise maybe £50,000 from friends and family, or £150,000, your standard UK SEIS angel round. And you're going to use that money to get to a prototype, ideally to launch, something that's there that people can play with and use. Your next ripple, your next round, you're going to be raising maybe £500,000, and that's to get to some level of traction. And that might be then to create that product that from the prototype into something scalable. You'll use the money for marketing and growth. And the third round, the third ripple, will be raising £1 or £2 million for your Series A round. And that's where you've reached revenue. So now investors see tangible, oh, you've got tens of thousands of users, you've got tens of thousands of month or more in revenue. And now this is a sure bet that the money we're going to put in is going to be for customer acquisition and scaling. So you prove the model. So in my 3 ripples model, your goal is to raise 3 times, each time raising 3 to 5 times the amount you raised last time, at 3 to 5 times the valuation of last time, such that by the third round, you either don't need to raise again because your company is now profitable, or you're ready to exit the company and you as founders and the investors make a great return on your time investment and the investors' money investment. So if you think broadly that you might be aiming for 3 funding rounds, your goal as founders is to have more than 50% equity at the end of the third round. Why is that? Well, it leaves you with a majority shareholding, which is good. It also leaves you with enough skin in the game. So if you're 3 founders, 50%, that's 17% each. You know, if you're 2 founders, 25% equity. If it dips much below that, certainly in an early round, you start becoming unattractive for investors because they know that founders don't have skin in the game. If the investors have more equity than the founders, it is worrying. And so I see a Slack discussion, for example, at the moment where the founders are going into their seed round raising 500K, that they made some really big mistakes by giving friends and family or an accelerator way too much equity early on. And now the founders together only have 40% equity at the point of their seed round. And investors are basically having a discussion going, no, we're out. It's just too hard to fix. So your goal, if you want to have more than 50% equity after the third round, also magically equates to diluting 15% each round. So if you're diluting, if you're giving away or selling 15% equity 3 times, that's 0.85 to the power of 3. You end up with about 65% or something like that equity. And then you might have a 10% option pool. So that's like 55%. So magically, the numbers work out at 15% dilution each round. Now, when I look on SeedLegals, having run the data over hundreds of rounds, and you'll see this on the SeedLegals resources data section, guess what? I see companies selling or founders selling a median of 15% equity in each round. So when you're doing your funding round, your goal is ideally not much more than 15% dilution in the round. And in your early round, you'll make a 10% or thereabouts option pool as well. So the 15% figure actually then can also be used in another way, which can help you figure out how much you should raise. So here's what I see typically. As I mentioned, you know, the 3 ripples in a sense. You might raise 50K through to 150K for that first friends and family or angel round, then 500K, then 1 or 2 million afterwards. And that then matches a valuation, which is basically you multiply the amount you want to raise by 5, so that you're selling 1 in 6, because the investors get, the valuation plus the investment amount. They own that fraction of the total, the post-money valuation afterwards. A bit techie, sorry about that. So if let's say you're raising £100,000 and you set your pre-money valuation, that's the valuation without the investment, at £500,000, after your round, your valuation will be 500 plus 100, 600K. The investors will own 100K out of 600, which is 16%, which beautifully matches. So in fact, the problem space of what valuation to pick is almost the same as how much should I raise, but of course, with some caveats around it. So now, and I'll be almost facetious, I see valuations fall into the following bands. So a couple of founders get together, have an idea, 300,000 valuation. Okay, you've built a prototype and you've shown some people, okay, £500,000 valuation. Oh, you've got some app live in the App Store, £700,000 valuation. Oh, you've got some users, you've got a few thousand people using, great, £1 million valuation. Oh no, you've got revenue like 10,000 a month. Okay, it's not going to fund the company, but it's proof you're getting revenue, 2 million valuation. And north of 2 million valuation, it's usually a function of revenue. So if you're doing, so by the way, the multiplier on revenue might vary, but for a moderate growth company, it might be 10x annual revenue is your valuation. So if you're doing £20,000 a month in revenue, that's £250,000 a year, that might be 2.5 mil valuation. Doing 50K a month in revenue, 600K a year, £6 million revenue valuation. Now, of course, that's just a benchmark. If you're a cheese shop and you're selling pretty much the same amount of cheese every year, no one's going to value you at 10x revenue because it's not going to be the same in a year's time. It might be a 3x multiple. But if your revenue is increasing dramatically month on month, maybe you'll get more than a 10x multiple because by the time a year has arrived, your revenue is going to be much higher. You can justify a higher valuation. So now let me get to a few questions. So James, do you want to pick a question?
Yeah, there hasn't actually been many on this part. I think shares seems to be the thing that everyone's struggling with the most. We do have one about how much should you give a NED? What's the typical percentage to give a NED?
Right, great question. So, NED, a non-exec director, or, a director or advisor. So I must say, I'm not a big fan of advisors and directors. So I see often on pitch decks, and they're often sort of crypto or blockchain related pitch decks, where people think it's important to have an advisor to bring cred to the business. And your goal is to have the advisor, a senior person in the industry, and that will help investors invest, which is great. The question is, how much equity should you give them? Or maybe there's an advisor who says, I'll come and help you on a daily basis. And for that, I'd like 5% equity. Is 5% a good number or is it a crazy number? So when you're talking percent equity, it's very hard to come up with a number. It's all quite arbitrary. So what I like to do is I like to put it in a sort of pound equivalent. So if your company has a valuation of £1 million and a director or an advisor says, I'd like 10% equity for being a board member and pitching up once a month at your board meetings, that 10% is £100,000. But you can hire 2 developers working 24/7 on your product for the same equity or same cash equivalent as that director. So that seems way too much. So I think if you have a director who's going to pitch up once a month, what's the value of that? Well, ideally, they should do it because they love you and maybe they have invested. But if they want some equity, yeah, maybe 5 or 10K a year, maybe 5K a year sounds about right for pitching up a day a month. And then that means if your valuation is £1 million, somewhere between 0.5% and 1% equity. So by thinking of it as a pound value, it's much easier to come up with a number and also to justify the number with the director or the advisor, because of course you need to, if there's a big perception difference. They're going, why is he saying 0.5%? I wanted 5. And you're going, oh, well, it's 5K a year. And by the way, whenever you give the advisor or director equity, it should always, just like your employees or yourself, vest over a period of time. Because if you just give them their 1% on day one, there's no incentive for them ever to do anything or pitch up at your board meetings. And what if they turn out to be terrible and you want to get rid of them? So you should do an advisor or an NED agreement with them, which you can do on SeedLegals, totally free. And in that, you should say that you'll get your shares or share options, as they may be, vesting over, typically for an advisor, it might be 1 year, and maybe you'll renew it after that, or maybe you won't because their job's done. And that then means by having an NED or advisor agreement, you're also setting out the things that you're expecting them to do. And that's really, really important, because otherwise if you go, yeah, I'll give you some shares, what are they going to do on a daily basis? When you call them the 4th time to say, can you make an investor intro? Are you asking for favors, or do they have to do that? So always make an advisor or an NED agreement that clearly sets out their responsibilities and then the shares that you give them as a result. Next question, James.
Okay, so we've got one about the SeedLegals platform here from Tony, just asking, he's planning on getting grant funding as his first source of finance. So is SeedLegals going to be suitable for his legal needs?
Okay, so I don't get involved with grant funding. I think there's a site, Grant Tree, and there are a couple of others that focus on grant funding. So very quickly on grants versus investment. So grants are on one hand great because they non-dilutive. In other words, you can get money from the government. If you can get money, you don't have to give away equity. So that's great. You still own all your equity. And actually, it's nice validation for investors afterwards. If you manage to get Innovate UK to fund you, that is a good vote of confidence that you're doing really good scientific work. The challenge is that it's quite a lot of effort with quite a low chance of success often on some of the funding pieces. So the government's got many different funds. There's BBLS where you can get 50K or 25K as a loan. If you need that, knock yourself out, go for it. It's fairly easy to do. If you are looking for Innovate UK, it might be 6 months till they get back to you, and you may have a 1 in 10 chance of getting funded. So for me, time is money, and the time that you spend writing up the application and waiting and the chance of it not happening, all of this, you're in a sort of, holding pattern, you're treading water when you could have, in the alternative, been out and getting investment or, getting on with it. So my take is, if you're at the point where your startup changes from a hobby, I've got this idea, I've still got my day job, but then changes into something full-time, you want to run it like a military operation. You want to be laser focused on making it a success. And that means everything that's not aligned with getting the product built, getting traction, is a diversion. And when people talk to me about, should I incorporate in Delaware or, the Cayman Islands, or should I set up a subsidiary, or should I get government funding? These all have useful long-term potential benefits, but they all come at the cost of you're going to spend a lot of time on something that isn't the laser focus. So if you can have someone in your team apply for the funding while you're not taking a foot off the accelerator doing other things, go for it. Or if you really can't get any other funding, or you're exactly the university spin out that government focuses on, go for it. But otherwise, you may find it's much easier and faster to actually give away some equity and get some angel investment and give them SEIS or EIS instead. All right, so one more question before I go on to the next.
Well, there's a couple of questions about crowdfunding, and
yep.
They're just the benefits of it versus angel investment. What I'd just say on that is they kind of go hand in hand. So for most crowdfunding sites, crowd cube seeders, for example, you're going to need 40 to, between 20 and 60% of the round already committed, usually, sometimes as much as 80% before you're going to be accepted onto their platform anyway. So you're kind of going to, if you're going to go down the crowdfunding route, you can't ignore the angel investment route unless you've got friends and family that are, or who are committing what is needed to meet the crowdfunding credentials. I don't know if there's anything you want to add there, Anthony.
Yeah, I think by the way, that's a really good question, and one which every founder is always, flirting with, what should I do? So here's my take, which is your absolute lowest cost of capital, as I call it, is finding angel investors who want SEIS and EIS. Why? Because those angel investors, because of the SEIS and EIS requirements, can only get ordinary shares. They can't ask for preference shares and anti-dilution and all sorts of crazy stuff that costs you money later. Secondly, your total cost of closing their investment, you're not paying anyone else. It's just your legal fees. And on SeedLegals, it's like a maximum of 1% of the amount you're going to raise, probably less than that. So if your lowest cost is always reaching out, finding angel investors, go crazy, post on LinkedIn, put in Facebook groups, talk to everyone you know, tell them you're raising, make a nice, lifestyle picture of your product, stick it on LinkedIn, make a nice slide deck with James that you can send out to people. And that's your lowest cost way of raising from people who are going to put in 10, 20, 50K each. But of course, there's some problems. So number one, if you're raising £1 million or £2 million, that's a lot of angel investors. So at that point, you're going to run out of the ability to do that with angels, most likely. So you're going to have to get funds involved. Or number two, maybe you just can't find angel investors yourself. You don't know enough people. And then what do you do? And at that point, you've got two options. Number three, one, you can go to crowdfunding. And so the crowd companies will help you find a crowd. But what people often discover, most people already know this, is that your crowd campaign is meant to pop. You keep reading Monzo, within 8 minutes of it opening on whichever crowd company, they already had 70% of their campaign subscribed. Amazing. The dirty little secret is actually that money was pledged ages ago. So when you do your crowd campaign, actually you're expected, I would think, often to get something like 50% of the funds already committed. Then it pops on day one, and then you get more crowd afterwards. Nothing wrong with that, so long as you know that those are the rules of the game. So the problem with the crowd campaign is threefold. One, you still have to get a bunch of angel investment or investors you find yourself up front. Number two, if you are trying to raise with angel investors and it's not working out, it kind of fails silently. But if you've got a crowd campaign that's live, it fails publicly, it gets pulled, it disappears, and then it's harder to do again later. So the cost of it not working is much higher. And thirdly, the cost of capital, as I say, is maybe 6 or 7% or something, which is what the crowd companies would charge, as opposed to essentially zero for doing it yourself.
Just on that, just in case people are interested, the next event I'm going to be doing in a month's time, I'm going to be sharing tactics and strategies that our clients have used to get their rounds oversubscribed, just using their own network and using angel investment strategies. So if you are interested, look out for that event next month, and we'll be talking in more detail about ways to manage and grow your campaign and create a buzz around what you're pitching. So yeah, look out for that. But let's move on. There was a question about SCIS. But I'm guessing
okay, and just before I do that, I'm going to say there's one other thing, which is you can also look for an advisor, somebody to help you find investors. So that's always tempting, because sometimes as a founder, you know all about dialysis or CBD or whatever it is, but not about investment. Should you get an advisor? And so advisors are helpful for helping you create a business plan, pitch deck, proposition, but they may also be helpful at finding investors. The problem is investors often see it as a kind of, not a failure, but they see it as less good if an advisor is trying to pitch the company rather than the founders. I think investors often see the founders having the ability to pitch, and the outreach from the founder is super important. So if you're an investor and your PA sends them, hey, I'd like to set a date next week with John who'd like to pitch to you, that's really not the go. You're expected as founders to have learned the art of the pitch and to be able to pitch directly. But if that's not you, you can certainly work with an advisor, and an advisor will often charge 6 or 7% or thereabouts as a sort of investor finder fee as well. So turning now to advance assurance, I'll cover that quickly because I think many people know of that. So, SEIS and EIS, tax savings, fuel the UK startup ecosystem. That's why it's the most buoyant in Europe. And it's really good for you as founders because the investors have to get ordinary shares, which avoids lots of preference share requests and other stuff that's less good for you. So what's happened in the past is that sometimes there were companies who weren't sure they could qualify for SEIS or not. So HMRC opened a kind of a helpline that said, if you're not sure, you can write to us and we'll tell you whether you'll qualify for SEIS or not. But that's now fallen into a pattern where investors generally ask you, get your advance assurance from HMRC and then we'll invest. So advance assurance is where you write to HMRC and they tell you, yes, you'll qualify, and you get a nice letter, and then you can show that to your investors and tell them that you'll qualify. It's not legally required, but it's often the difference between an investor going, yep, I'm in, or come back when you've got your advance assurance. So getting advance assurance is very useful to do, and you should ideally do that before you start going out to talk to investors, or rather pretty soon afterwards, because having it is just helps you close things faster. And HMRC has been making it steadily more difficult to cut down on their work because the number of incomings has grown. And so they now say that you need to have found so you've got a bit of a catch-22 where you need to have found a substantial percent of your investment before they'll give you advance assurance. So we think that number, they've never said exactly what it is, we think it's about 30%. So if you're applying for £150,000 of advance assurance, they would like to see evidence that you've got maybe 50,000 committed. And that means you need to provide the name and address of it and the proposed investment of one or more investors totaling at least 30%, we think, of the amount that you're looking to raise or get advance assurance. Now, these don't need to be committed. They need to be potential aspirant. So being HMRC, I wouldn't make it up. And you should definitely talk to the person going, hey, can I put you down? You're not committed. Great, amazing. And I'll let you know when I get my advance assurance. And then you can do that on SeedLegals. And I think we do something like 1 in 5 of all advance assurances in the UK are now on SeedLegals. So
just on that, Anthony, there's a question here which is an interesting one. There's some confusion, it seems, for Tony when it comes to SCIS. He's heard that it can't be given to friends or family even though they're their first investors in your company. Is that true?
So it's a great point. So SEIS, you have to essentially be an independent investor. So what does independent mean? It can't be a father, mother, or son or daughter, but it can be a brother, uncle, or aunt, and it certainly can be friends. So it's really just parents and children who are disqualified. And any employee of the company is disqualified, but otherwise there's nothing to prevent you. And in fact, friends and family is one of the key benefits for me of SEIS, because, let's say you get your friendly family to invest in your business and your business goes bang. It's an unpleasant Christmas dinner to be had. But, hey, if they could write off their the investment when they made it, and write off the loss afterwards, their loss was quite small overall. So you can still talk to each other afterwards if it doesn't work out. So I think SEIS really turns I'm not going to talk to my family into, okay, the risk's low enough and the loss is low enough that we can have that family conversation. All right, so let's talk about agile fundraising. So once upon a time, doing a funding round sort of was the following. 1, figure out how much I want to raise. 2, figure out a valuation. 3, find a lead investor, because it was all far too complicated. And then the lead investor goes, agrees the valuation with you, and then finds other investors. Anyway, all of this takes like 3 months to get the investors together, then 3 months to close the round. Then, because it was so expensive, you don't want to do this again until you can get a lot more traction and raise at a higher valuation and raise a lot more. And you need at least 6 months to actually do something with this money and get more traction and more users. So that's another 6 months. And then you can't risk trading insolvent. So you need at least 3 months worth of money in the bank. So that's 15 months. So what we had is we had these 15 or 12 to 18 month go big or go bust funding rounds. So as a founder, you raise a ton of money. You got lots of money in the bank. It's awesome. This is going to last forever. And then you start hiring people. And then, of course, it always takes longer to get traction. And then there's no revenue because that's taking longer. And now the money's going down month on month. And it gets really stressful. I've been there. So it gets crazy stressful at the end when you have to start looking your team in the eye and you're burning 20 or 50K a month, and that's that pool of money is like going down. You see the wall coming up. So why does it have to be that way? So what I found is on SeedLegals, people kept coming to me going, hey, I'm looking to raise 300K, but I've got this investor who'd like to put in 50K now. What do I do? And instead of saying, well, you'll have to wait, you can now, we didn't invent it, we productized it, and we called it a seed fast. So there's always been something called a convertible note. So convertible note says the investor gives you money now, and it will convert into shares. In other words, you'll give them shares later when you do a funding round at a valuation to be determined in the round later. So a convertible note is great because it means that you don't need to decide the valuation today, which is useful for 2 reasons. 1, I have no idea what the valuation is today. Let's wait till later when we figure it out. And 2, let's say that, as I said earlier, the ripples in the pond, if you've just got a PowerPoint, your valuation might be a few $100K, if you could even decide what it is. But once you've got some traction or you've got your app developed, it might be 3 times that amount. So wouldn't it be great if I could get some money now, but essentially at tomorrow's valuation, not at today's valuation? So that's what a convertible note is. But there's a problem with a convertible note. A convertible note in its pure form says the investor can get their money back or they can get interest. And both of those aren't compatible with SEIS or EIS. And we know the UK is fueled by SEIS and EIS. So a variant came out called an advanced subscription agreement, which is kind of like half of a convertible note. It says, I will give you money and it will have to convert into a round later on. And HMRC have now said it has to convert within 6 months. So you can now go out to people and say and raise, promising that they will get shares within 6 months if you do a round within 6 months. And if you don't do a round within 6 months, it will convert to what you call the low valuation. So you may pick some valuation that you agree will apply if you fail to do a round in 6 months. And now the cost of these seed fasts on SeedLegals starts at like £100. So I see people using it to raise anywhere from £2,000 upwards. And I see founders, I think the record is a founder who literally raised 100 seed fasts, raised £250,000. Pre-COVID, I think every weekend she went out partying dinners, and on midnight on a Sunday night, she did another 2 or 3 seed fasts. It was insane. I think every time she met someone, she said, "What's your email? Can I send you a seed fast?" That it really transforms the way people can raise investment instead of waiting for all the investors to get on the bus together. As you meet people, you can raise up front. And my suggestion is, don't go crazy and raise everything you need in a seed fast or seed fast, because they have to convert in a round within 6 months. Instead, you might plan to raise 20 or 30% of the total you are planning to raise up front, and then you'll do a funding round later and they'll convert in the round. Now, the other thing that might happen is I found people calling and saying, "I'm looking to raise 500K, but I've got 300 lined up. What do I do? Do I wait to raise the full amount, or do I close now?" So we thought that's a bit of a unhappy binary option. Why can't you just close the round and then top up later? So again, we didn't invent it, but we productized rolling close rounds. So when you do a round on SeedLegals, you can now say, "I'm looking to raise 300K, and I'd like to be able to top up another 200K between now and June next year." And when you top up, those investors sign what's called a deed of adherence that joins them to this last round. So the same deal terms as the round, except that you can increase the valuation. And that's amazing, because when you think of it, when you're doing a funding round, it means you're giving away equity at today's valuation for money that's going to last a year or so. But in a year, your valuation is going to be hopefully much higher. So why are you giving away equity at today's valuation that's really much of it's at tomorrow's valuation? Whereas a rolling close round lets you close a smaller amount now and then top up as you get to more traction at a higher valuation. So my favorite way of raising funding, and I think the ones that I see people doing increasingly, is they'll raise as much as they can raise and as much as they can get to sustain them for 9 months or so. It may not be as much as they really would like, but it's more than like 2 months, because otherwise you're forever treading water. But then some months later, they're back and they start topping up, and they just keep topping up until they reach a different profile of investor who's looking for different deal terms. So when you do a funding round with a bunch of angel investors investing 10 or 20K each, they're looking for particular deal terms. They might be looking for certain investor consent rights, or they're not looking for a board seat, or whatever it might be. But later on, if you're raising £1 million, a fund will be looking for different deal terms. So they probably won't want to join on to your last round. They would want a new funding round where they get preference shares and a director seat and investor consent rights. So what you really want to do is you want to do a funding round on nice founder-friendly deal terms as far as you can do, and then keep topping that up until you reach a different profile of investor, and then you're on to the next round with the next type of deal terms for a fund investor. So, questions?
Anthony,
James,
yes,
take it away.
So with a convertible note or a seed fast, can you fix the minimum value that an investor would exit at, therefore making it more attractive to them?
Yeah, so that's a great question. So when you do a funding round, it's like playing the next move in a game of chess. So remember, your goal is to raise several rounds, and you're going to dilute a certain amount each time. And as founders, you want to, be in control of the business in several rounds' time. What steps should you make each time? And, there you can chat with us on SeedLegals and we can help with that. But in the early stages with SEIS investors, it's generally quite standard, and you pick the valuation and so on. When you do a seed fast, it's like playing a game of chess 2 moves out, because I'm giving you money as the investor now, and it will convert in your next round. So now you have to think, what will my next round be in a few months' time? What if I don't do a next round? What if business is okay and I do a round at a low valuation? What if business is awesome and I do a round at a really high valuation? What happens if business is so good that I'm profitable and I don't need to raise more? I still need to convert your seed fast. So you need to think of a few scenarios. The simplest one is that it just converts in your next round, and you give the seed fast investor a 10 or 15 or 20% discount compared to what the new investors will pay because they're coming in earlier. And that's their incentive for coming in earlier. But they also might want, and here's the question you asked, which is what's called the valuation cap. So they might say, your valuation today, I'm guessing, is $1 million. Maybe in 6 months' time, it will be 1.5 million. To protect me from being diluted, just in case you find some crazy investor who will invest at a 3 mil valuation, I'd like my investment to convert at a 1.5 mil valuation cap. So that means if you raise above £1 million or 1.5 mil valuation, I still get shares as if it was 1.5 mil. Now, I'm not a big fan of giving out or agreeing a cap because it's dangerous. If you promise an investor 10 or 20% discount, great, nothing really can go wrong. They're going to get a discount. They're giving you money up front. It's easy and predictable. But where I see founders occasionally making a mistake is they think, well, my valuation's today $1 million. I will put a cap of 1.5 mil. But it turns out that business is really good and they've got an investor who's happy to invest at a 3 mil valuation. But now the seed fast investor is getting 2x the number of shares than they should have gotten. Now, if it turns out that they were going to get 2.2% equity for their 20K, it's neither here nor there. They got a great deal. But if they were getting 5%, which now becomes 10%, that's been a costly mistake. So, if you agree a cap or your investor insists on a cap, be quite cautious in picking something that's not too low, lest you get burnt later. All right, let's take one more question. Now, I think we're probably not, given we're out of time, we're not going to cover the other points, but I think it's been a great session.
Yeah, absolutely.
I think we might, maybe we'll do another session on some of the other points.
Yeah.
So, but let's take a couple more questions.
So I think you've covered this, but just to be really clear for Tony, he wants to just check that the valuation that you're using when you're doing the seed fast is the valuation of the previous round or the current valuation of the company, and it doesn't change every time.
Well, I mean, the point of a seed fast is that you are not agreeing a valuation. So if you are agreeing a valuation, you almost can just give the investor shares, right? Hey, you're investing 100K for 10%, I'm going to give you this number of shares. But the reason for having an agreement that says I'll give you shares in the future at a valuation to be decided later is because you don't know the valuation. But what you do usually want is you need to bookend it with some possibilities. Is what happens if you never do a new round and the investor has to get their shares in 6 months in order to get their SEIS, what valuation will it be? So there you agree what's called the low valuation, which will apply if you don't do a round. And you might also agree a cap to say, if I agree a higher valuation, so you're going to bookend what it might be. But apart from those bookends, the point is you kind of not agreeing the valuation.
Anthony, I got that wrong. He didn't mean seed fast. He meant the top ups after you close a round, so rolling close.
I'm sorry. Great point. So let's say you raised 300K at, let's say, a 1.5 million valuation, and now you want to top up. So I think it falls into probably 2 patterns. One of them is essentially a late investor. So, if you think of a funding round like running for the bus, if you miss the bus, we'll get you an Uber later. So if you didn't make it to our round and you come in a month later, we're not going to try and agree a new valuation, because the act of trying to agree a new valuation a month later is pointless. We're just going to do it at the same price per share as the previous investors paid. So in other words, it's as if the valuation really is unchanged for people coming in the next few months. But after a few months have gone by, it's fair play to increase the valuation. And now, of course, you have to guess what the valuation might be. And that I don't know. So you might say, I closed my valuation in January at 1.5 mil. I'm planning to raise in June next year at a 4 mil valuation. We're kind of like a third the way between them. So maybe it's like 2 million now. I think that's a rational way of doing it. The problem occurs, of course, is once you've done an investment at 2 mil, it's kind of hard to do less than that afterwards. So now, you might stay with 2 million for a while, and then maybe you'll jump to 3. I don't know, but that's the beauty of it. What you want to do is you want to get traction. So now be able to give away fewer shares for the same investments. In other words, increase the valuation. And also create the demand, because ironically, for anyone who's raised investment, they would know it takes forever to get investors interested. And as soon as your round's about to close, you suddenly have all these people calling you going, hey, can I join your round? It's like, dude, if you only called me like 3 months ago. And then instead of saying no, or trying to hijack the rounds and squeeze them in, which is usually a big mistake, because then everything falls apart. You were about to get everyone's money, but now you've changed everyone's equity because they're getting less equity because you're adding more investors. And this guy now wants to look at the deal docs and change everything. So adding people late in the round risks destabilizing everything. And instead, you might go, tell you what, I'm just going to close a round. I'm going to do an instant investment top up for you afterwards at the same price per share as the investors were paying, but you're going to come in later. I'll order the Uber for you personally, essentially. So there's the answer on that one.
So,
all right, let's go with one more question, maybe.
Yeah, very last question. So I think Joey might have answered this for and on the chat, but just to check. So with the shares, say one person has incorporated the company with 100 shares in their name. Does the original shareholder now have to issue the shares to another potential shareholder, or can you use the SeedLegals resources to just add a shareholder and use the certificates as evidence?
That's a very good point. So almost it's like, why does SeedLegals exist in the first place? What's all this legal stuff you're doing? So, at base, you have shares, they registered on a company's house, and you've got a spreadsheet that says who owns the number of shares. And a shareholder is simply an entry in that spreadsheet that says, I've got more shares. So if you wanted to make more shares for people, you can basically just go into Excel and add another row and add some shares, and then create an SHO1 form and file it with Company House, and you've got more shares. So why didn't you just do that? So there are a couple of reasons. Number one is when you incorporate your company, you start off on what's called the model articles. So companies need to have some governance. Can an investor just sell their shares at any point? Who can they sell them to? Can you cancel their shares? So there are all sorts of rules that need to be in place. So Companies House and the Companies Act define the sort of base level rules, and many of them are in the Company Act law, and some are in what's called your model articles that you get when you create your company. But the model articles are perfect for you if you're a cheese shop. Cheese shops are not high growth companies that have exits. They just sell more cheese. So the problem with the Company House model articles is, for example, the board needs unanimous consent, which can lead to deadlock if you can't agree something. And they also don't have what's called drag along provisions. So let's say you, as the founders, have got 70% of the shares and you wish to sell the company. and you're going to make some money out of it. Awesome. But you've got some minor shareholder with like 10 shares. What if they don't want to sell? What if they want you to pay them personally £1 million for their 10 shares? Otherwise, they're not going to sell. It's like those, big new Westfields that go up and there's one person with a terrace who's refusing to sell. So that can kill your company. So what you want is something called drag along, which is a provision that says if more than 70% of the shareholders want to sell, the little ones have to sell on the same terms. So there are a whole lot of provisions that you want to add that let you sell the company, and likewise protect you as the founder, and similarly investors protect themselves. And that's really what SeedLegals is all about, to create those legals to protect both parties. So that if you just create another share certificate and give the investor their share certificate, they're not really bound by very much. They might sell their share to a competitor of yours. You might wake up and find a drug cartel is a part owner in your business. So how do you prevent that? And so really the documents, the funding round you create on SeedLegals will create what's called preemption rights or transfer preemption, which means if that shareholder wants to sell their shares, they can do that, but they have to offer it to the other shareholders first. Or if you want to make more shares to protect the investor, you have to let them buy those shares, pro rata to other people. So all of which is to say, you could just create a share certificate for somebody, but it's probably not the right thing to do. And also if they want SEIS or EIS, if you do that, it might make it a lot more difficult when it comes to get your SEIS certificates from HMRC. It might look like it doesn't fit the pattern that they're expecting with a set of deal documents that show them as a proper investor, and then it becomes a bit more fraught. I hope that answered the question.
So I think Joey has probably given the best piece of advice today on that chat. Sorry, Anthony, he's stolen the show. But what he said is if you have any questions about anything legal to do with your startup, go to SeedLegals first, because if they can help, they are by far the most cost effective and the most efficient. And they'll tell you if they can't help, and then you can go find a solicitor that can. And I think that's probably the best bit of advice for everyone on this call is your first port of call should be Anthony and the team at SeedLegals, because they are awesome. And they're much more cost effective than your high street, well, not anymore high street lawyer, and your locked down lawyer. And they're gonna be able to point you in the right direction. And if they can help, you can trust their advice. And if they can't, they'll point you in the direction of people who can. So I think that kind of wraps us up for today. Thank you ever so much, Anthony, for coming along and sharing with us all of your knowledge and expertise. It seems like you could probably do a whole hour on share and share structuring by the sounds of it. There was so many questions there. But let's have a look at putting an event in the diary for a few months' time to cover off the things that we didn't get around to covering off today, because there's just so much that people want to know about the complexity of the legal side of raising investments. So it'd be great to have you back at some time and go through the other bits.
With pleasure. And if you want to cover more topics or you've got any questions, either head over to SeedLegals and hit the web chat, or just hit me up at anthony@seedlegals.com. and I'll see if I can answer. And I or one of my colleagues, we can hop on a Zoom call and help you get set up.
Yeah. So before we leave, just to remind you that if you want to get the recording for this video, it will be posted into our Facebook group. And if you do want to just check and assess how investor ready you are in terms of your pitch materials, not your legals, obviously, but your pitch materials, your business plan, your financial projections, then head over to pitchready.co.uk and fill in our short 30-question survey, and you'll get a bespoke 12-page report. So that's my little plug. But yeah, thank you all for coming along. Thank you, Anthony, and we'll leave it there, and everyone have a great evening. Speak to you all
right.
soon.
Thanks, everyone.
Bye, everybody.
Thanks for the great questions. Bye.
Bye.